Welcome back. It's been a great run for the GreenCandle portfolio. We've seen fantastic execution on the trades from MP Materials, Modine Manufacturing, and BP. It's time to look forward at the next massive structural opportunity. While the market chases digital dreams, we're focusing on the thermodynamic reality required to power them. Today, we're breaking down the atomic arbitrage, the bull case for Cameco, ticker symbol CCJ. Let's get into the data. Look, everyone is obsessed with the digital gold rush, AI, data centers, the next big language model, but they're completely ignoring the physical reality required to power it all. We're about to hit an energy wall, and the only way through it is nuclear. Today, we're breaking down the atomic arbitrage, the bull case for Cameco. But first, a quick reality check for the lawyers. This is not financial advice. Do your own due diligence. We are only here to provide educational data. The math here is terrifyingly simple. For a decade, the world hated nuclear. We underinvested, closed minds, and pretended wind and solar could do it all. They can't. Now, the IEA says we need to grow nuclear capacity by 20% by 2030 just to keep the lights on for AI. The result? A structural deficit of roughly 70 million pounds of uranium per year by 2028. We aren't facing a cyclical upswing. We are facing a supply panic. It gets worse when you look at the map. Where does nearly half the world's uranium come from? Russia and Kazakhstan. Russia is sanctioned and weaponizing energy. Kazakhstan is dealing with massive floods and logistical nightmares, cutting output by 20%. The cheap, reliable Eastern supply chain is broken. If you want secure, Western-friendly pounds, your options are dangerously limited. This is where the market is getting it wrong on Cameco. They still treat it like a volatile commodity miner from 2007, just digging dirt and praying for spot price spikes. That's the old Cameco. The new Cameco bought 49% of Westinghouse. They don't just own the best mines, they own the fuel processing and the actual reactor technology that utilities rely on. They've transformed into a vertically integrated energy behemoth. Westinghouse is the game changer. It's a high-margin service business that generates predictable, boring, recurring revenue, over $500 million in EBITDA expected for 2025. It acts as a massive stabilizer against volatile mining swings. Plus, Westinghouse is the Trojan horse for those small modular reactors that every hyperscaler from Google to Amazon is desperate to get their hands on. You always want to be on the same side of a trade as Uncle Sam. The U.S. government has realized it has a massive strategic vulnerability and is stepping in. The DoD is buying billions for a strategic uranium reserve. The Inflation Reduction Act is handing out 10% production tax credits. The government is effectively de-risking the entire trade and putting a taxpayer-funded floor under the stock price. Now, let's do the real math on where this is going. As Cameco's old cheap contracts roll off over the next few years, they get replaced by new long-term contracts priced near that $130 per pound reality. You take that massive jump in mining profit, add in $1 billion of stable EBITDA from Westinghouse and fuel services, and by 2027, you're looking at a company potentially generating $3.3 billion in EBITDA. The bears will point to today's 45 PE ratio and scream that it's too expensive. That is lazy, backward-looking analysis. You don't value a company undergoing a massive structural transformation on last year's depressed earnings. When you apply a proper infrastructure monopoly multiple of 20x to that future $3.3 billion EBITDA, the path to a $150 share price isn't hope, it's just arithmetic. Let's steelman the bear case and be adults here. Are there risks? Absolutely. Mining is hard. They missed production targets in Q3, and high interest rates make new projects expensive. But unlike the last cycle, Cameco now has long-term contracts that lock in high pricing regardless of short-term delays and a net cash-positive fortress balance sheet. They are built to weather the volatility. We don't have to wait years for this to play out. February earnings should show the profitability inflection point, but the massive catalyst, the one that wakes up the entire retail market, will be the moment a tech giant like Microsoft publicly announces a massive long-term power deal with a Westinghouse SMR. That is the ignition point. Looking at the chart for CCJ, the setup is textbook. After a massive 25% impulse move higher, the stock is digesting those gains in a clean bull flag consolidation. We're watching that $84 to $87 zone as major institutional support. The RSI has reset, and it looks coiled for the next leg higher. That's where the smart money is reloading. So, what's the game plan? For long-term investors, use any pullback into that $84, $87 zone to accumulate your core position for the multi-year run to $150. For more active traders, implied volatility is high, so look at January the 26th bull call spreads, like the $90 and $110 bull spread, to define your risk while playing the breakout. Be disciplined and let the price come to your levels. And if you're looking for income, selling cash-secured puts, like the John $26.75 put, is a great way to collect premium and potentially get paid to own the stock at a lower price. We are buying the inevitable re-rating from a simple commodity miner to critical global infrastructure. If you want more actionable data like this without the typical YouTube hype, smash that like button and subscribe to GreenCandle. Let's find the next runner. Class dismissed.